Good afternoon, ladies and gentlemen, and welcome to the One Heritage Group PLC interim results investor presentation. Throughout this presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time using the Q&A tab situated on the right-hand corner of your screen. Just simply type in your question and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company review all questions submitted today and publish responses where it's appropriate to do so. These will be available on your Investor Meet Company platform, and we'll send you an email when they are ready for your review. I'd also like to remind you that this presentation is being recorded. Before we begin, we would like to submit the following poll. And I'd now like to hand over to Luke Piggins, Group CFO, and Jason Upton, CEO from One Heritage Group. Good afternoon.
Good afternoon. Thank you for attending and welcome to our maiden interim results presentation. I'm Jason Upton, CEO of One Heritage Group, and I'm joined today by Luke Piggin, our Finance Director, to run through the presentation. We are just going to start by turning off our cameras whilst we run through the presentation. We'll turn them back on again, ready for any questions later. Okay. So, to begin, who are One Heritage? We are a residential property development and management company, and we focus on developing high-quality, self-contained apartments, both refurbishments and new build projects, along with the development of co-living accommodation, primarily in the northwest of England. We were established 2 years ago in the UK with our roots and brand tracking back to 2012 in Hong Kong, originally a wealth management business, diversifying into UK property several years later, which led to establishing One Heritage here in the UK and the property development and management business we are today. Our services expand further than just a developer, with lettings, co-living projects and property management services within the group, along with acting as a development manager for third-party owned developments. So looking back over the period under review, we set 6 strategic priorities for the group, and I'm pleased with how these have been successfully executed, especially given the backdrop of COVID over the last 12 months. Firstly, we achieved our listing on the London Stock Exchange in December, the last one of the calendar year, where we raised 930,000 for 31% of the share capital of the company at 10p a share. We initially saw positive growth of our share price during January, which was partly due to the lack of liquidity and formed part of the rationale for a further fundraise last month for 548,000 at 30p a share. And the proceeds we used to fund the acquisition of a new development in Stockport. And overall, we're pleased with early investor demand to execute a placing so soon after listing. And in preparation for our listing, we took steps to establish a strong business infrastructure, appointing 2 non-executive directors who bring exceptional industry experience and knowledge to the board. And further key hires were made over the period in a finance director and a development director, 6 additional staff, and a further 2 post-year ends. And this gives us a solid platform to grow the business and enables us to execute our strategy over the forthcoming period, with the team offering tremendous value to the business. It's also pleasing to continue to see new and exciting development opportunities, which resulted in 2 new projects being acquired and a further acquisition following the fundraise last month. These projects will create 169 self-contained apartments, and with the project duration to last around 12 months for each scheme, we expect to be completing these from December through to the first half of 2022. And overall, with an exciting pipeline of projects for the business to deliver over the coming months. Another element of our strategy also covers co-living. We took the first steps towards entering the lettings and property management markets in March through a 47% share in One Heritage Complete. And this provides various services, including lettings, property management and refurbishments. And with good demand from investors for co-living property, we saw excellent growth with 42 new refurbishment projects and a further 129 new tenants under management over the period. And finally, primarily through our wider group in Hong Kong, we took steps to further establish our sales and marketing framework with the team primed and ready to increase sales activity as we progress through our development schemes over the course of the year. So to recap our business model, our strategy covers 3 core elements. Firstly, we're a residential property developer. We acquire development sites within the group, which are either new build or redevelopments of existing buildings, such as offices, which the group converts into self-contained apartments. We target development projects of anything between 10 to 100 apartments, and are usually projects with a shorter construction timeframe, such as 12 to 18 months, to maximise the return on capital deployed and reduce the risk associated with longer construction timeframes. And in terms of location, primarily focusing on the north of England, areas of growth and with demand from young working professionals, along with good transport links to city centres. And we currently have 5 development sites within the group with a gross development value of 23.9 million, with all schemes very much in their infancy, and profits will generate once completed and sold, which we expect to be as early as December through to the first half of 2022. Secondly, we act as development manager for schemes owned by a third party, whereby the group receives a management fee for our services, along with a profit share of the completed and sold schemes. And currently we have 2 projects under a development management agreement. One Heritage Tower in Manchester, which we achieved outline planning for last year for 545 units and 55 stories. And a former courthouse in Oldham we're converting into 43 apartments, which we achieved planning for last month. And finally, the third element being co-living. The group undertakes various services within co-living, which I'll come on to later, but the income for the group is generated similar to our development management projects, whereby we receive a profit share of sold co-living properties. And additionally, we hold a 47% share in a group of companies that provide lettings, property management and maintenance, with profits generated from this group. So these 3 core strategies we believe provide a good balance. Our own developments as developer, receiving profits from our projects, which is balanced by development management projects, and our co-living activity, which is generating a recurring source of income, which is especially beneficial considering the equity tied up in developments until 2022. And these income sources provide regular cash into the business, which is advantageous with developments committing equity, therefore providing strong income. What we believe gives us a competitive advantage is our wider group in Hong Kong and Asia. This network is mainly through our majority shareholder, One Heritage Property Development, who are based in Hong Kong, and provide the UK group with a key sales and marketing function, providing the ability to maximise returns quicker by selling overseas, and having a presence and infrastructure in the Far East we can access, who understand the cultural differences to effectively market and sell our property, brings significant benefits to us as we look to take the risk out of selling developments at the earliest opportunity. So to provide an overview of the 5 developments within the group currently, these contain a mixture of new builds and conversion projects, which are all primarily in the north of England, which is an area we will continue to focus on. Our projects are at similar stages, with Lincoln House, Oscar House and Bank Street all having commenced construction, and our Churchgate development in Leicester and Plus House in Stockport are awaiting planning approval, which we expect over the coming months. The largest scheme on the left, Lincoln House, we achieved planning for this year, and we've already started works on site. This scheme saw us resubmit planning to make use of the space more efficiently. When we bought the scheme, the design was poor, the apartment size is small, and we've since redesigned the building along with changes to the specification, which included replacement of the cladding to improve the overall aesthetics, along with the safety benefits of this cladding change. And our recent acquisition on the right, Plus House in Stockport, which we're unfortunately waiting for a CGI image for. We're excited by this development being in the centre of Stockport, which is an area we expect to undergo significant redevelopment and further value to be added to the property in the region. And the attractive aspect to this development is it's centrally located within walking distance of the train station. Trains run every 10 minutes to Manchester, with it only being a 10 to 15-minute train journey, which we believe will be attractive to young working professionals. And whilst we've not outlined profits for our developments, as we tend to build contracts, progress design and sales, we are targeting a minimum return on cost of 20% across our schemes. With the short construction timeframe we're targeting gives us a good return on capital deployed. And I'm expecting to provide a further detailed update on progress and sales of each of these developments in our annual results later this year, which will provide a better reflection on progress, given at that point we should be several months away from completion. And I'd now like to take you through two of our developments in a bit more detail to understand what type of projects we're looking at and targeting. This example is our scheme in Sheffield. We acquired at the end of December our Bank Street development. We've already started construction works on this development, which demonstrates our ability to act quickly, with an expected completion around Q1 next year. This project is a conversion of a Grade 2 listed building, which will create 22 high specification apartments. We're excited by the design of this scheme in particular, as you can see on the right, which are examples of our duplex style apartments, whereby we're retaining the ceiling height and character of the building to deliver unique apartments, along with retaining the external elements as well, shown on the image on the left. And these conversion projects form part of our core strategy, as they tend to be in central locations, some with the benefit of permitted development rights as existing buildings, and reduces the planning risk versus the risk of new build projects. And these are usually developments we can act quickly on, such as this development in particular, with reduced construction timeframes, again further mitigating risk of delays and maximising our use of capital deployed into a project. And where we specifically add value to these schemes is utilising the experience of our team, with our development director specialising in the conversion of historic buildings, who is also a chartered building surveyor, along with a further 2 chartered surveyors within the team and a chartered town planner, who have added value to maximise the space and design in particular, which we believe is bringing a fantastic product to market. Another example of our targeted projects is our Oscar House development on Chester Road in Manchester, which is a new build scheme. This site had the benefit of existing planning, which allowed us to move to site quickly and reduced any subsequent planning risk following acquisition, which could lead to further delays. And what we have with this development is a modern-looking building located on the edge of Manchester city centre, within an area undergoing regeneration, and a significant development around the area. This development is attracting significant interest from investors, and we actually have an underwrite purchase expected to be signed for all 27 apartments, which reduces the exit for us on this development scheme in particular. And new build projects also form part of our core strategy, and whilst they may not be in as central a location as our targeted conversion projects due to the lack of land to build on in prime city centre areas, it does give us the opportunity to capitalise on areas of growth and investment, as we are with this development in particular. And again, where we add value is our internal team, with further design changes to the specification, such as the pleated facade, which will be our 2-storey duplex apartments on the roof of the building, with a residence terrace, along with incorporating smart technology and modern design across the building, which we believe will appeal to young working professionals. And works have commenced on this development, including drainage installation currently and due to be completed in the first quarter of 2022. So in March last year, we took the first step in entering the lettings and property management markets by acquiring a 47% stake in One Heritage Complete, which are a group of companies providing property services. And this essentially provided an infrastructure for the business to offer co-living property investments to investors, providing the ability to source, design, build and offer full letting services for properties. We saw better than expected growth and demand within these companies, which was partly restricted by the first national lockdown, which closed the property market, but ended the year well with significant growth across the group, which saw a 110% increase in the number of projects undergoing refurbishment, totaling 42, a further 50 properties under management, bringing the total to 150. 129 new tenants were added, meaning we now have over 400 tenants under management. And to support this growth, we added 26 new staff to the One Heritage Group, primarily within the maintenance business, now meaning we have 65 staff within One Heritage Complete. And a further 2 offices were opened in Manchester and London, which expands our offering of property management to new locations. So this growth overall generated a £53,000 profit share from One Heritage Complete. And the sales of properties in particular that have been sourced and converted and sold in Hong Kong, we had 23 in total, which sold, generating 143, close to £143,000 in profit back to the group. And I'm pleased to report we've already surpassed this total for the first 3 months of the year. So demand remains strong and bodes well for the rest of the year. And as I touched on earlier, our business is supported by our wider group and its sales and marketing network, specifically in Hong Kong and across Asia. With the One Heritage brands established in Asia for over 8 years, the group's well placed to benefiting from accessing these markets. The wider One Heritage Group in Asia contains a licensed trustee company regulated by the SFC in Hong Kong. And whilst providing wealth management services, it's a well-regulated and respected entity with a focus on property, marketing our stock exclusively. And this, we believe, provides a significant benefit to us, which we aim to capitalise on over the coming months as we market our developments. So I'm now going to hand over to Luke to run through our financial review.
Thank you, Jason. I will now take us through the financial review. During the review period, we were pleased to raise $930,000 in the capital raise at an issue price of 10p per share. That equated to 31% of the post-capital raise shares in issue. These funds went towards the existing developments. We did complete on 2 acquisitions, totaling £2 million in purchase costs in the period. Oscar House on Chester Road in Manchester. We acquired it for £1.2 million in August last year via the acquisition of Generation 100 Limited. This entity just held the asset on acquisition. At the end of the calendar year, we acquired Bank Street in Sheffield, which was actually a straight asset purchase. In advance of the IPO, we did some restructuring. This included the transfer out of 2 SPVs. One held the tower and the other, Harley Street, held 3 co-living properties. And these transactions are detailed a bit more in note 5 in the interims. An important element of the restructure was the £2.75 million debt for equity swap by our then sole shareholder, One Heritage Property Development in Hong Kong. This gave the group a permanent equity base in order to progress with our strategy, which Jason has set out. Overall, we did generate a loss in the period of 227,000, which I'll cover in more detail in the following slides. The group's NAV per share finished the period at 9.25p, which was a consequence of the above factors, in particular the debt for equity swap. Post-period end, we were very pleased to be able to raise a further 550,000 through a placing and subscription at 30p per share. This went towards the acquisition of Plus House in Stockport. At the same time, our largest shareholder increased its facility to 7.5 million from 5 million on a conditional basis. This increase is to be used where we are unable to raise construction finance on reasonable terms. The NAV bridge is a useful visual of the transactions that we undertook in the period. We did the debt for equity swap that provided the capital base, which was then augmented by the net IPO funds before taking into account the loss for the period. This brought our NAV at the end of the period to just south of 2.8 million. The key balance sheet transactions have previously been touched upon to some extent. In the developments, we acquired 2 assets in the period, Oscar House, the Chester Road site, and then Bank Street. We also progressed with the existing developments towards getting the sites ready for construction to commence. This additional expenditure includes some planning costs, site preparation, and a bit of capitalised interest. We disposed of 1 Heritage Tower and Harley Street, which removed 14.2 mil of gross assets as at the 30th of June values, and it was 15.5 mil at the time of disposal. This was matched by a movement in the total borrowing during the period and reflects the NAV of the entity disposed. It was 16,000. We increased our commitment to the main co-living entity by 1 million to 2 million in the period. The profit participation loan is actually recognised as a financial asset at fair value through profit and loss. On the other side of the balance sheet, we signed 2 loan agreements for 1.1 mil in July and 1 million in August with 1 Heritage SPC. This is a related party to the group. The loans charged a 12% interest rate and are repayable in 18 months' time. I mentioned the debt for equity swap of 2.75 mil, where 1 Heritage Property Development was issued shares which were paid for by repayment in the loan facility. The final point was the further increase in related party borrowings, which were linked to some of the co-living entities and the managed entities. In the 6-month period to the 31st of December, the group saw the beginnings of its revenue generation with recognition of development management and co-living related income, 2 of the 3 areas highlighted in our business model by Jason. In co-living, revenue was generated through our profit participation loan, which saw the completion of 23 sales. This earned 143,000 in revenue in the period, or an average of 6,200 per sale. We also earned a share of profit from 1 Heritage Complete, the associate, of 55,000, and actually received a cash dividend of 26,000 in the period. We invested 250,000 in the associate back in March 2020. The other key revenue driver coming from development management, this generated 44,000 in management fees from our agreement with the tower, I would note that the agreement was signed partway through the period and equates to 0.75% of cost. Given the stage of development of both the Oldham County Court and Tower sites, we are unable to recognise any further income. The rental income related to the Harley Street SPV that was disposed of and therefore will not reoccur. Administration costs rose 158% from the comparable period as the group put in the infrastructure to drive future growth. This rise was mainly a consequence of staff costs, which were 200,000 higher than the comparable period, as the average number of employees more than trebled from 3 to 11. We also saw increases in advertising, some corporate expenses and professional fees. The administration costs do include the staff salaries, as I touched upon, office costs and professional fees that were not directly attributable to the developments or the capital raise, therefore we couldn't capitalise them. I would note we have more employees at the end of the period than we did at the start and acquired additional staff in the post-period end, and that will be reflected in the numbers going forward. Overall, the group did generate a loss for the period of 227,000, which was an increase overall of 44% compared to the comparable period last year. Capital management has been and will always be a key focus in the business. To this end, we secured an extension of our loan with PMJ Capital on our Lincoln House development and expect this to be ultimately repaid when we agreed terms on construction finance. We raised 2.1 mil from One Heritage SPC in 2 tranches, July and August, which are repayable in the 18 months. This was funding for the Oscar House Chester Road acquisition, and then capital that was advanced to via our profit participation loan for co-living. From a liquidity point of view, we have a group facility from our major shareholder, One Heritage Property Development Limited, which was extended from the 5 mil at the period end to 7.5 mil in the post-period end. This was actually undrawn as at the 31st of December, and along with our cash balance of 374,000 at the end of the period gives the group sufficient capital to progress with our strategic priorities that Jason has set out, and will ultimately build us towards our target of 400 completed units per annum by 2024. Thank you. I'm going to hand you back to Jason, who will cover the outlook.
Thank you, Luke. So over the forthcoming period, we have set key strategic objectives for the group. Our primary focus is to successfully deliver our existing developments, and we're fully committed to achieving this and excited to bring our finished product to market over the next 12 months. Alongside this, we expect positive pre-sales as we look to secure an exit on our developments prior to practical completion, allowing us to access the equity to redeploy on new schemes quicker. As I mentioned earlier, co-living generates robust income into the group and will continue to support One Heritage achieve targets and their continued growth to support demand over the period. And as we progress through the year, I'm expecting to add to our exceptional team who will be critical to our success. We have a strong core development team which we may need to add to depending on workload, along with our back office functions such as finance. And we've taken steps to prepare for this and look at our recruitment strategy. And part of this planning includes taking advantage of our location in central Manchester. And we've been talking to Manchester University recently with a view to integrate new graduates into the business to develop new talent. Our development director presented a lecture last week for the university on our business as a developer, which attracted a lot of interest, and good steps to build our brand and recruit the right talent for the future. I also expect to continue to invest and develop in our own team internally with continuous personal development core to our working culture. And finally, we will be looking to capitalise on new opportunities in the market to build our development pipeline for the future, with our target being 400 units per year by 2024. We continue to see exciting opportunities, and our future success will be dependent on building a pipeline of projects which we are committed to plan for and deliver.
Jason, thank you very much. Oh, sorry, my apologies.
I was going to say, just wrap up with a conclusion quickly. So, in conclusion, we remain positive about the general outlook for the market and remain already seeing demand increase from investors, which I expect to continue as restrictions ease over the coming months. Our commitment and focus continues to be on the north of England specifically, with the group well positioned to benefit from initiatives such as the government's levelling up agenda in particular. And whilst we're pleased with progress, we are generating a steady source of income from our development management projects and profit participation from co-living, with future profits from developments not until around H1 2022. But we are in a strong cash position, with the vast majority of our operating costs covered by other income sources. And finally, thank you for listening. So we'll now take some time to answer any questions.
Jason, Luke, thank you very much indeed for the update and the investor presentation. Could I please ask, ladies and gentlemen, to continue to submit your questions? Please do so using the Q&A tab situated on the right-hand corner of your screen. But just while the company take a few moments to review the investor questions submitted already, I'd like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your Investor Meet Company dashboard, and we will send you an email to notify you when they are ready for your review. I would also like to remind you that your feedback is important to the company, and immediately after the presentation has ended, you'll be redirected for the opportunity to provide feedback in order that the company can better understand your views and expectations. Jason, Luke, obviously investors had the ability to pre-submit questions. We received 2. So ahead of going into the live Q&A, I wondered if I could start off by asking you the following. The first question reads, it would seem that the period to the end of this financial year will be used to build out the infrastructure of the company and to progress the development projects. Is it expected that the majority of the 169 flats under development will be sold in the next financial year? Is it too early to give a flavour of the purchase interest being shown via the marketing teams in the Far East? Perhaps I could hand over to you for a little bit of expansion on that.
Yeah, thank you. So in terms of sales, the simple answer is yes. We do expect the majority of the 169 flats under development to be sold, and this remains our target. We're pleased with progress today. 15 sales at Lincoln House, and we expect to sign an underwrite agreement, as I mentioned earlier, for the purchase of all 27 apartments at Oscar House in the coming weeks. We did make some mistakes early on by marketing our Lincoln House development in particular too soon, which meant we had to go back to buyers with some revisions to the design causing inconvenience. This is testament to the demand at such an early stage in the programme. And we're confident by delaying sales and marketing until just before construction begins. Once we have planning fully approved, leaves plenty of time to sell the units, and gives us more flexibility to make changes to the design and scheme if required. Therefore, the marketing and sales of the 3 schemes we're progressed with currently at the moment, Lincoln House, Oscar House and Bank Street in Sheffield, will be the immediate priority over the next few months, with Plus House and Churchgate following thereafter a few months later.
That's great. Thank you very much indeed. The other question we received ahead of the event reads as follows. I invested at the listing based on the profit potential of the development projects alone. Having seen the returns from the co-living business, I underestimated the potential of that income stream. Does the business consume any capital, or is it all funded externally? How many properties were sold to generate the 142,000 of gross profit? And finally, it goes on, I note that 37 properties are currently under refurbishment. While you cannot forecast future profitability, would it be reasonable to assume that the profit per unit to date is indicative of future unit profitability? Apologies for such a long question, but perhaps I could give it to you.
Yep, sure. So the co-living business model works well for us. We mentioned during the presentation the income's generated from two sources in particular. Profits generated from a £250,000 investment into One Heritage Complete, the complete group of entities last year, which provided the group with over £53,000 in profit over the last 6 months of 2020. We don't expect to contribute any further capital into the One Heritage group of companies. The co-living entities have received some initial funding from the group, but we're not expecting to see any additional capital contributed, and if anything, may see the flow reverse back into the group over time. The co-living sales specifically generated 143,000 of revenue, and as I mentioned during the presentation, we've already exceeded this in the first 3 months of this year, which is extremely positive for the year to come. And on average, income generated is between 4,000 to 8,000 per property for each individual co-living property sold to an investor.
That's brilliant. Thank you very much indeed, Jason. And that does take care of those questions that were pre-submitted. There's a number of questions that have been addressed during the meeting. If I could ask you just to have a look at the Q&A tab, which is on the right-hand side of your screen. If I could ask you to read out the question, perhaps even who it's from, and where appropriate, give a response. What I'll do then is I'll pick up from you at the end and look to conclude the meeting and go and take investors to give feedback. So over to you, if I may.
Yeah, okay. So I've had a question from Darren. On the co-living side, do you see an acceleration of activity as we exit lockdown? So we do expect to see an acceleration from tenants, and as the social mobility increases, as lockdown restrictions ease, there's positive for the residential market. In terms of acceleration of co-living refurbishments and property sales, it hasn't been restricted to the UK restrictions. Demand has remained strong from overseas investors in particular. Occupancy levels have performed quite well as tenants seem to stay within good co-living accommodation, and positive for the market once restrictions ease over the coming months. Then I've got a question from Vanessa. You mentioned that you're still awaiting for planning permission on 2 of your developments. Can you update on progress and what the risks are? So to provide an update on expectations for Churchgate and Plus House, the 2 developments we're awaiting a planning decision for, we're expecting this over the next 8 to 12 weeks, assuming no delays with the planning authorities in particular. Regarding risk and progress specifically, the Churchgate development is situated within an old historic wall of the city within a conservation area. This has meant we've had additional considerations for the development, especially considering they found King Richard III under a city centre car park a few years ago. So the university have especially been active conducting archaeology surveys on the site over the previous few months, and luckily haven't found anything exciting. And it's also meant we've had to progress the design further, submitting a pre-application with the planners in consultation with the conservation officers, which are seen as make some design changes to the frontage of the building, setting back the top floor, and factoring in further feedback from the planners. So some delays to the planning application, which has since been submitted, and now with the planners to approve. The Plus House scheme in Stockport, we did previously report it had the benefit of permitted development rights, which it still does. However, we've identified an opportunity to add further value to this development in particular by adding 2 additional stories to the roof of the building, changing the design and layout of the building specifically, which has meant a resubmission of planning for that scheme in particular. This we do believe will add significant value. However, in the unlikely event we don't achieve the revised planning for the Plus House development in Stockport, the existing scheme utilising the permitted development rights is still a profitable scheme with us in line with our profit targets. What else have we got here? Views on residential market this year. So I think the residential market surprised everyone last year. And although performance might not be the same this year, we do expect positive performance. The UK does have a structural undersupply, and these factors do push up prices. The Northwest is outperforming the UK average. We expect further relative outperformance as investment increases in the region, thanks to the government schemes, as we mentioned. It continues to attract people from other areas of the UK. We still see significant potential in the northern region. Prices are still relatively affordable. Rental demand expected to increase as restrictions ease, as I mentioned earlier, along with continued demand from overseas investors in particular. We do remain confident in our business strategy and the market. What else have we got? Anything you'd like to pick up on, Luke, in particular?
Yes. So John A has actually been kind enough to ask quite a few questions. I'll answer some now where I can. So John A asked, I appreciate that you're brand new to the market. Can you tell us in the long term about your potential dividends and future dividend policy? We can't set out exactly what our dividends will be in the future, but we are obviously looking to pay a dividend as soon as we can. And when I say that, it's when we're able to offer a stable and reasonably predictable dividend in one period and going forward as well. We don't want volatile dividend distributions, so we will review it annually and obviously keep people updated. If that's sufficient. Darren also asked, how do you see the current climate for development funding, and what sort of terms would you hope to achieve for your group-owned developments? Internally, we're very happy with the progress so far. Parties that we've approached like the assets, they like the management team, and they like the story. And there is quite a reasonable number of players in the market, which is good. Some are slightly picky to the extent that COVID has reduced people's bandwidth to actually process new applications and things. So I've noticed this in the retail banks in particular. There is a tendency to focus more on existing customers rather than new customers. But we are progressing quite well with that. From a term point of view, like it's very standard industrial terms really. We're targeting around 65% loan to cost. The arrangement fees and exit fees are 1 to 1.5% in and out, and then the margin can vary depending on what the entrance and exit fees are, but you're kind of in the range of 6 to 7% margin.
Okay, got a question from John again. Can you tell us about the market opportunity in the Northwest? So I think what we're starting to see is a significant emergence of the regional towns and cities, Bolton scheme in particular. The peripheral towns around central Manchester and cities such as Stockport, they're attracting a significant amount of investment currently. And we believe it's a good opportunity to come in at the right time with significant value add. So we know in Stockport in particular, excited about that particular central location with it being so close to the train station. And I know there's plans to expand the tram network out to Stockport and Bolton in particular. There's the government initiative for the Levelling Up Agenda and Towns Fund for Bolton. So it's an exciting time and significant amount of investment. So there's a good amount of kind of conversion opportunities. Again, Stockport and Bolton, disused buildings we can acquire and turn around in our targeted timeframes of 12 to 18 months. And continue to remain positive for the opportunities over the course of the year. Another question from John: what level of demand are you predicting and seeing from overseas clients? So I think the demand from overseas clients isn't a surprise. It's continued to remain strong from the Far East in particular for a number of years. Manchester seems to be the second alternative to London. Good entry prices. The price point you're looking at for an apartment in Bolton, 150,000. In comparison, it's not going to get you a great deal in London. So I think it's a different market. They're excited about the story. Manchester's got particularly good brands. The universities, high retention rate of students, high population of international students. They know the football teams. The northern powerhouse and investment into the northern region from the government. Particular. Can see a great potential in the northern regions in comparison to London.
Jason, Luke, thank you very much indeed. I know you've addressed quite a lot of those questions that have come through. I don't know if you just want to give that one look through just to make sure that we haven't missed any, and then perhaps I could ask you for a few closing remarks, and then I would either investors to give feedback. But just in case there is anything on that Q&A tab that you want to address now, and thank you to investors for submitting those questions. Of course, anything that we don't get through in this session, we will review post the meeting.
Perfect. So, yeah, thank you for attending the presentation this afternoon. Hope it's provided further clarity on our business strategy and priorities for the group over the forthcoming period. We have 5 developments we're fully committed to deliver, and everything will be put into making these a success. We have an exceptional team of people and a strong business model, so remain confident in our ability to execute strategy and targets over the forthcoming period.
Jason, Luke, thank you very much once again for updating investors around these results. Could I please ask investors not to close this session, as you'll now be automatically redirected for the opportunity to provide your feedback. If you access this meeting via our platform, then the feedback page should appear. If you access this meeting via the link sent you by email, you'll be simply asked to log back in to provide your feedback. And if you could devote a couple of moments of your time to do that, I'm sure the company will find that very beneficial. On behalf of the management team of One Heritage Group PLC, I would like to thank you very much for attending today's presentation and for your time. That now concludes today's session. Good afternoon, or should I say good evening to you all. Thank you.